If you're a macro trader, you know that feeling, right? Being completely overwhelmed by data? Well, in this explainer, we're going to dive into a tool designed to fix exactly that, the FOMC Macro Bias Dashboard. We'll break down how it works and how it can bring some serious clarity to your trading. So let's start with a problem that I know every single fundamental trader has faced. You're trying to build a solid macro bias, but the sheer volume of economic data, it's just relentless. It's a real challenge trying to find a clear signal in all that noise. I mean, it all comes down to this, doesn't it? Trying to figure out what the Fed is going to do next. It's the multi-trillion-dollar question that moves the markets. Are they hawkish? Are they dovish? Where do you even begin to form a solid directional bias that you can actually trust? Exactly. You're constantly juggling non-farm payrolls, then the latest CPI inflation print comes out, then you've got the quarterly GDP numbers. One piece of data says one thing and another says the complete opposite. It can honestly feel like you're just guessing, trading completely blind in a fog of conflicting information. But what if there was a way to distill all that chaos into a single, clear signal? Well, this is where the dashboard comes in. It's designed to be the solution to all that macro confusion. So what is it? The FOMC Macro Bias Dashboard takes all those complex essential data points and just boils them down to a single daily bias score for the US dollar. The whole goal is simple: replace confusion with a clear, quantifiable edge. Okay, so how does it actually do that? Let's pop the hood for a second and deconstruct the macro scores to see what's really driving this powerful indicator. The dashboard's logic is built on these four key pillars you see right here: inflation, the labor market, economic growth, and financial conditions. Each one is weighted and scored, combining for a total possible score of 100. Let's break each one down real quick. First up, the inflation score, which is worth up to 25 points. This measures price pressure in the economy, which is, arguably the number one thing the Federal Reserve is focused on right now. And here's the key takeaway. A high score means inflation is running hot. That pushes the Fed to be more hawkish, which is almost always bullish for the US dollar. A low score means inflation is cooling off, giving the Fed room to ease up, and that's bearish for the dollar. Simple, direct logic. Next up, we've got the second key component, the labor score, also worth 25 points. A strong labor market is the other half of the Fed's dual mandate, so this is an incredibly important piece of the puzzle. And the logic here is very similar. A high score means the job market is tight and resilient. This keeps the pressure on the Fed to remain restrictive to prevent the economy from overheating, which provides some real underlying support for the dollar. Then we have the growth score, weighted at 20 points. This is all about the overall health and expansion of the economy, typically measured by GDP. A growing economy, to put it simply, can handle higher rates. You can see the connection here, right? When the growth score is high, it signals a strong, expanding economy. That gives the Fed confidence to stay hawkish without worrying about a recession, which, again, is bullish for the USD. And finally, we have the financial score. Now, notice, this one has the heaviest weight at 30 points, and there's a good reason for that. This isn't backward-looking data like the others. This score measures what the market itself is doing right now. This component looks at real-time indicators like Treasury yields and the dollar index, or DXY. So a high score here means the market is already voting with its money, pricing in hawkish conditions. It's a powerful, real-time sanity check on everything else. Okay, so we've seen all the components. Now for the most important part. How do we take all of this and turn it into an actionable trading signal? And this is where it all comes together in a beautifully simple output. The four scores combine to give you a total out of 100 and a clear, color-coded bias. Green, for scores over 70, points to a strongly bullish USD environment. Red, below 40, is bearish. And orange, right in the middle, signals a more neutral or cautious stance. But here's a feature I find really, really useful. The dashboard adds another layer of risk management, these confirmation levels. It checks if the dollar index and 10-year Treasury yields are actually breaking key technical levels. So if the signal is confirmed, it means market action is supporting your bias. If it's on watch, well, that's a smart signal to be patient until the market agrees with the data. So here's how you could fold this into your daily routine in 4 simple steps. First, you check the total score and bias from the dashboard. Second, you identify the structural filter, which is just asking if the current price action on your chart aligns with that bias. Third, you get that extra layer of safety by checking for the DXY and 10-year confirmations. And finally, you apply that complete confirmed bias to your trading. Easy as that. So, who is this tool really for? Let's see if it's the right fit for your trading style. This tool is absolutely perfect for swing or position traders who need a reliable macro filter. If you trade major Forex pairs, indices, or commodities like gold, and you're looking for a systematic way to get a directional edge, this is built for you. It's not about giving you entry signals. It's about making sure you're trading with the dominant macro flow, not against it. So if this sounds like the missing piece in your trading plan, the final question is how you can get access and start using it. You can get instant access to the FOMC Macro Bias Dashboard for TradingView right now. All you have to do is head over to premiumindicatorlab.com to get started. And that brings us to the final thought. This is all about moving from a state of confusion to one of clarity. So the real question is, are you ready to stop guessing and start trading with real macro conviction?